what happened the week of the bailout. Monday, March 10th, the stock imploded on Friday. The company basically imploded starting Thursday night, and over the weekend was gone. So this is a Monday before, this is just days before. CEO states, gives a press conference, Bear's liquidity cushion is sufficient to weather the credit market contraction. Everything is wonderful, everything's terrific. 5 days before they go out of business. I checked the book value in several sources. It ranged from 84.03 to 96.88. That means, like, if you sold all the assets, you should have gotten somewhere between $84 and $97 for one share. The balance sheet indicates 33 times leverage was being used. This is enormous leverage, and a number of Wall Street firms are only slightly below this leverage. And any little thing goes wrong with this, you can get an implosion, and that's what happened. No Wall Street analyst had a sell recommendation on this stock. I went back and looked. Next day, interesting, we do not know this happened until the following week. The SEC has a report which it released a week later saying that the cash shortfall, Bear Stearns was basically severely out of cash on Tuesday. Now, keep in mind, this wasn't public release, so you would not have access to this information. We have it now. Keep in mind, the very day before the CEO went on, gave a press conference saying everything's fine. The day before, I mean, one day before. S&P releases a report heralding the end of the subprime write-offs. The market had a big rally on this report 1 day before Bear Stearns blows up from the subprime problem. 1 day. Friday, March 14th, Thursday night, basically, Bear Stearns fell apart. Bear Stearns gets an emergency 28-day loan from the Fed. This was announced after the close on Friday. It was happening during the day and from Thursday night on, which is funneled through J.P. Morgan. This is an important thing to realize. Utilizes law from the 1930s that allows it to loan money to corporations to justify its actions. The Fed was not allowed to loan money, basically, to Bear Stearns. On the conference call to analysts, this is Friday afternoon, the Bear CEO states the liquidity position has markedly deteriorated. A fact, finally. Because of market rumors. Not, and this is my note, not because of management incompetence, or because management had presented false financial figures, or Bear was actually insolvent. None of these things. It's rumors, it's short sellers. It's just because it was being talked down, had nothing to do with reality, or it wasn't their fault. They didn't have anything to do with this. He actually stated the book value is fundamentally unchanged. Keep in mind that's somewhere between $80 and $90. Okay, by Sunday night, now there's a lot of press in Barron's and on the internet's really lively about this, saying, you know, they better not open on Monday without bailing Bear Stearns out of the whole financial system would go. The Fed arranges for J.P. Morgan to buy Bear Stearns for $2.52. Now, the value, according to the CEO, on Friday afternoon was between $80 and $90-something. I mean, their hard physical assets were worth more than this price. I mean, that's how low this. This price was saying that the financial assets had a negative value. They didn't have a zero value; they had a negative value. What you should worry about is, can you trust any of those other book values for the financial companies? Okay, the Fed guaranteed $30 billion of trouble mortgage bonds on Bear's books. And the Fed hires, not J.P. Morgan, not Bear, the Federal Reserve hired BlackRock to manage these bonds. That means we, the United States, taxpayers own these worthless bonds, right? And we have bailed, the taxpayer has bailed out Bear Stearns. So after lots of controversy, J.P. Morgan raises its bid to $10 a share. Now keep in mind this is from 80 to 90 something dollars. It is still a very small fraction of what it was. Whenever there is a bailout, whenever you see, oh, the Fed did all these great things, there's losers and there's winners. There is no free lunch. If some good thing is allegedly happening, someone else lost money somewhere else. Stockholders, big losers, including the smart money. You constantly see it in press. Oh, the smart money, they did this, they know this. Barron's does this all the time. It makes me like want to vomit. You know, there's a difference between smart money and big money. When you have big money, you can frequently move prices and make things happen. That doesn't mean you are smart. That means you have a lot of money. And you know, they are not synonyms, but in the financial press, they're considered to be the same thing. There's a billionaire in Britain named Joe Lewis. He bought over $1 billion in Bear stock in June 2007. Mutual fund manager Bill Miller, who is quite famous for beating the S&P like 15 years in a row or something, major holder of Bear Stearns, wiped out. He's not beating the S&P this year. Credit default swap holders. This is something that we mentioned last time. These are the insurance. There's about $45 trillion of these. They could collapse the system by themselves. They were in the money on Bear Stearns. You buy insurance on the bonds. They had huge profits. Now, if Bear went under, they would have made a fortune. And you know, it says in the contracts basically if there's a bankruptcy or insolvency or whatever. But Bear did not become insolvent because it was bought by J.P. Morgan. So once again, the Fed has taken people with a huge pile of money and takes all the money away from them and gives it to somebody else. The people who screwed up get the money. The people who were correct get screwed. The losers also U.S. taxpayers. We're going to be paying a lot of money from this, although they're probably going to borrow it if some foreigner will lend it to us before we have to pay it. The winners, bondholders win in this type of deal. The people who issued the credit default swaps, obviously. J.P. Morgan basically got a whole bunch of free assets in a riskless takeover. There's this huge effort to manipulate the market on the part of the government authorities right now. And they're doing everything possible to keep people optimistic. And this shows you what happens when people suddenly aren't optimistic. You just get a complete collapse. Now, if this was actually a well-run financial institution with very little leverage, you would not have, you may have gotten an attempt at a collapse, but nothing would have happened. It could have held up easily. This is so vulnerable, and most of the big banks and brokerage houses are so vulnerable, anything can knock them over.